I want to thank Tony for organizing this format and inviting us to present slowly unfolding disasters. And also thanks to Alan for being the facilitator for our paper. This is joint work with Mohammed, who is a PhD student at University of Houston, and Sang, who is also still in Houston, soon to join Wisconsin Madison. So do investors fear the possibility of another Great Depression? Answering this question with yes motivates disaster risk models and how they explain the high equity premium and the low risk-free rate in the post-war period. So in the rare disaster mechanism, first proposed by Reitz and then further developed by Barrow, we typically assume a small probability of a massive decline in aggregate consumption. So in typical Reitz-Barrow type models, disasters occur instantaneously. What gives rise to the equity premium is a large concurrent decline in consumption and equity prices. Even though there is no disaster realization in the post-war US data, the small chance that a disaster could occur gives rise to a high risk premium, and that is because it amplifies the compensation for instantaneous risk, which Marianne Prescott initially found to be quite small based on realized consumption data in the post-war era. So an important ingredient for these models is how large rare consumption declines should be. In Barrow's work and the literature following it, the size distribution of instantaneous disasters is calibrated to match large historical peak to trough consumption declines, and the duration of those declines is on average 4 years. So perhaps this can be seen as an innocuous simplifying assumption. Actually, it can be fixed quite easily. Instead of large instantaneous declines, we can model disasters as a persistent low probability regime with negative growth, like in Goryeo or Nakamura, Steins, and Barrow-Urzua. In this case, once the economy enters the disaster state, a gradual decline in consumption will accumulate to a disaster. However, a remaining challenge is that disasters in the data unfold slowly over multiple periods, not only in consumption, but also in financial markets. The average duration of stock market disasters is about 3 years, almost as lengthy as consumption disasters. And the problem is in disaster risk models, even when they model disasters as a persistent negative growth rate, asset prices fully respond immediately as soon as a consumption disaster starts. And regardless of whether consumption disasters unfold instantly or slowly, investors incorporate the negative growth expectations into prices all at once. This results in a counterfactually severe price decline in the market, and that's consequential for several asset pricing implications with which the rare disaster mechanism has been challenged in the literature. And that's what we are trying to address in this paper. So there are a number of challenges for the model, such as implications for the level of fix and appropriate mapping of the Euler equation to the data, and whether the equity premium really comes from instantaneous risk. So we will argue that the inability to capture the slow nature of stock market declines during disaster periods is actually what is behind many of those criticisms of disaster risk models. So the most direct example perhaps is the following. Welch finds that a put protected portfolio consisting of the S&P 500 index and the 1-month put option with 85% moneyness still earns a premium that's fairly close to the full equity premium. And his point is that if an abrupt and large stock price decline is the reason behind the equity premium in the data, this strategy should not earn a high premium because it cannot lose more than 15% per month. So the equity premium therefore cannot be rooted in disaster risk. So let's apply this argument to the Great Depression, the most prominent macroeconomic disaster in US history. During this period, the stock market declined about 86%, as you see here in the yellow bars. But there were only a few months with a monthly decline larger than 15%, as these blue bars show. So as a result, during the Great Depression, the put-protected strategy would still have lost 80%, as we see here in the right-hand figure, even ignoring the cost of purchasing put options. So the strategy would not have protected against the disaster. Therefore, we cannot really conclude that the fears of disaster periods do not matter for asset prices, based on this evidence. So as such, the real issue at hand is not rare disasters themselves, but the behavior of financial markets during disasters. And models that imply a one-shot drop in equity prices in periods like the Great Depression are problematic, because then risk premia are all attributed to large instantaneous declines that do not occur that way, really. However, beliefs about disasters as prolonged and volatile periods can still be relevant and also consistent with prices. So what we do in this paper is we develop a model with slowly unfolding disasters, as the title says, not only in the macroeconomy, but also in financial markets. The model features imperfect information, and investors cannot exactly distinguish whether the economy is experiencing a mild temporary downturn or is on the verge of a severe and prolonged disaster. So to illustrate the intuition behind the model, let's go back to the moment when Lehman declared its bankruptcy. At that moment, many investors, even policymakers, thought that we were perhaps facing another Great Depression. The 2008 crisis did not turn out to be a disaster like the Great Depression, but potentially it could have. And most importantly for us, at that moment, investors did not know with certainty whether or not it would. So the way we model investors' Bayesian learning under this uncertain environment causes equity prices to react slowly to persistent consumption declines during disaster periods. So we find that this unifying mechanism does not only generate slow disasters in the stock market like in the data, but is also powerful in explaining option-based movements like average VIX, variance risk premium, or risk premium on protected strategies that we just looked at. And those are the moments traditional disaster risk models usually struggle to address. So let's jump into the model. So it's a simple endowment economy with complete markets. The representative agent has recursive preferences. Log consumption growth is subject to an IID normal shock, as usual, with mean mu C and standard deviation sigma C, and also subject to a compound Poisson jump J. The Poisson process NT+1 here counts the number of jumps between time t and t+1, and it depends on the time varying intensity lambda t. So far, this setup is quite similar to variable disaster risk models like Wachter 2013. But in that model, J would represent a large shock to consumption where one realization represents an entire disaster, and this would be the rare event in the model, so lambda would be small on average. So different from that, Z and lambda here represent much smaller and more frequent jumps, as we will see later in the calibration. And lastly, following the consumption-based asset pricing literature, we will assume that aggregate dividend is levered consumption with a leverage parameter phi. So we assume that the jump intensity, which is the jump intensity over the next period, is observable. It follows the discrete time version of a mean reverting square root process, which is again similar to prior literature. But the long run mean of the jump intensity, lambda bar, is also time varying and depends on the true state of the economy. So the jump intensity mean reverts to a lower value in what we call the normal state for the economy, but mean reverts to a higher value in the depression state. And the market switching process as characterizes transitions between the normal and the depression state. It's 0 in the normal state, 1 in the depression state. A transition from the normal state to the depression state is rare but persistent. So when the economy stays in the depression state for an extended period of time, more frequent jumps in consumption can collectively constitute a consumption disaster. As a result, consumption disasters unfold slowly, as opposed to Wachter's model, but similar to other models like Goryeo. So in addition, we assume that there's an information friction. That is, the true economic state S is unobservable. The agent does not know whether the economy is in the normal state or the depression state, so she tries to learn about the state based on today's observed jump intensity lambda and its past history. Of course, the agent's learning is not perfect. The agent does not know with certainty whether today's increase in instantaneous risk is due to a transitory increase in risk in the normal state, which would be here a shock epsilon lambda, or due to a mean reversion to a higher mean under the depression state, which would be because lambda bar is high. So what are we trying to capture with this model setup? Let me use the Lehman example again. At Lehman's default, investors were aware of an increase in immediate economic risk, that is high lambda, which serves as the signal. Risk over the short run was high. But importantly, they did not know with certainty whether this event would trigger a prolonged economic downturn like the Great Depression, that is whether lambda was expected to stay high for a long time, or if the economy would recover rather quickly. In this model, the former scenario is a shift to the depression state, the latter a transitory increase in jumps. The aftermath of Lehman's default did not turn out to be a disaster, but potentially it could have. And the uncertainty whether it will is what we are modeling here. Now let me briefly talk about the agent's learning dynamics. Under imperfect information, we define pi as the agent's belief that the economy is currently in the depression state. Then Bayes' rule will imply that the agent's belief updating comes from two sources. First, the agent updates her belief based on a new shock to jump intensity. If the new value of jump intensity lambda t plus 1 is so much higher than its previous value, then it's more likely under the depression regime. This ratio becomes smaller, which raises pi. The second source of belief updating is the transition dynamics of S. So in the absence of any news, the agent's beliefs gets close to its steady state level. So in the paper, we derive expressions of the future belief as a function of current belief and current and future values of jump intensity. So in equilibrium, of course, the return on any asset will satisfy the Euler equation. Because of nonlinear learning dynamics, we solve for wealth consumption and price dividend ratios numerically as a function of lambda and pi, which are the state variables of this model. And given these two valuation ratios, we can then compute various conditional moments like equity premium, riskless rate, and even option prices. So we calibrate this model at a monthly frequency. The calibration of the preference parameters is standard. We set risk aversion to 5, elasticity of intertemporal substitution to 1.5. Transition dynamics between the normal and the depression state are calibrated to match the duration of US historical consumption disasters and the total years that the economy has spent in a disaster so far. Lastly, remember that consumption jumps in this model are small and more frequent than the case where a single jump would represent an entire disaster. Therefore, we will calibrate jump risk by using results from the option pricing literature. So consistent with studies like Ericke 2004, we will assume that on average, stock market jumps downward by 6%, and these jumps occur every other year during non-disaster periods. That pins down the size distribution of jumps as well as the jump intensity in the normal state. Since we set the leverage parameter to 3 like in many other papers, this translates into a 2% mean consumption jump. And that leaves us with two free parameters, intensity in the depression state and conditional volatility of lambda. And we use those parameters to target average equity premium and stock market volatility in the post-war period. So let's look at the model mechanism using a simulated path of the model that includes a consumption disaster. The blue line here represents the true state S. So we enter the depression state here. Once the economy switches from the normal state to depression state, jump intensity lambda enters an upward trend and consumption a downward trend. So the yellow line here represents the agent's belief, pi. We can see that the agent's learning is slow and it's imperfect. It takes more than a year for the agent to raise her belief of being in the depression state close to 1, and the belief significantly fluctuates as lambda is a noisy signal and sometimes points toward the wrong direction. So due to the slow learning process, the equity price does not fully react at the onset, as we see here. So it first reacts sharply, falling by more than 30% within 2 months actually, then recovers quite a bit. When the rise of lambda slows down around month 20, and then it continues to fall in a volatile manner as the belief stays high and lambda keeps rising. So in that sense, this is a path that actually resembles many properties of the Great Depression in terms of path and magnitude. So if the agent were fully aware of being at the beginning of a consumption disaster, equity prices would fully react right away. Also, the onset of the financial disaster precedes of the consumption disaster, as Barrow found to be the case for most disasters in the data. That would not be possible if the agent would learn from consumption itself rather than lambda, because then the agent would wait for a persistent decline in consumption to update our beliefs. And again, in the paper, we provide we write more about how the agent's belief affects various model quantities. So in order to look at quantitative model performance, we generate 10,000 simulated paths and calculate the finite sample distribution of each moment implied by the model. For standard moments in the post-war period, we simulate the model for 70 years. For option-based moments, we simulate the model for 28 years, reflecting the shorter sample period in the data. So we do not have any consumption disasters over the last 70 years. So we choose samples without disasters, following the literature. In this model, a single state variable does not tell us whether a disaster is happening or not. We can only identify disasters exposed as peak to trough consumption declines that are larger than 10%, just like how the disaster data set by Barrow and Urzua is compiled. So whether a switch to the depression state will last long enough to constitute a disaster is not known ex ante. Lastly, we will also look at population properties of the model by simulating a very long path of 1 million years. And to highlight what's different here, we will compare the model results with the data as well as those from the instantaneous disaster risk model of Wachter 2013. The year after, I will call Wachter's model instantaneous disaster risk model. And to examine the role of learning in isolation, we also consider a special case of our model with perfect information. The asset pricing implications of that special case are fairly similar to the instantaneous disaster risk model in most dimensions, because it also features instantaneous financial market disasters. So now let's see the results. This table shows that both our model and the instantaneous disaster risk model, which it was designed for, perform fairly well in explaining standard asset pricing moments, so high equity premium and return volatility, low and smooth risk-free rate, while matching the low consumption volatility. In the paper, we also show that both models generate return predictability, as well as a lack of strong consumption growth predictability. So those are also consistent with data. A striking difference between the two models is the difference between the properties of no disaster samples versus population. So the large discrepancy, so this is the median of no disaster samples, and this is the distribution from no disaster samples. The large discrepancy in volatility is a typical feature of instantaneous disaster models because of quick declines in consumption, dividends, and prices at disasters. We would usually disregard that because what matters for the post-war data is no disaster samples. However, with slowly unfolding disaster, population properties are not that extremely different from no disaster samples. This is just another reflection of where most of the differences will come from. Another important difference between the model and our model and the instantaneous disaster risk model appears when we consider what we call option-based asset pricing moments, like implied variance from VIX and the variance risk premium for the next month. All the numbers in this table are reported as monthly percentage squared terms. So here, panel B clearly shows that the instantaneous disaster risk model significantly overstates level and volatility of implied variance, as well as the variance risk premium. In contrast, the model with slowly unfolding disasters is able to generate realistic numbers for those moments in the data. So the real question is, where do those differences between our model and the instantaneous disaster risk model come from? These differences are rooted in how disasters unfold in financial markets. In fact, the assumption of instantaneous disasters is not innocuous. Here is an intuitive example. Compare 50% jumps versus 5% jumps. although both represent a 50% cumulative decline, the quadratic variation or the sum of squared returns differs tenfold. So that is, instantaneous disasters result in too high expected quadratic variation and even higher associated risk premium. Of course, disaster periods in our model will still be much more volatile than normal times just because more jumps occur, but it is not nearly as high as one-shot disasters would imply. And this issue is actually closely related to the Constantinidis critique on disaster risk. He points out something very fundamental, that the Euler equation is based on concurrent moves between SDF and asset prices. But Rees-Barrow type models with instantaneous disasters implicitly violate that premise. They treat disasters as one-shot shocks, which may artificially amplify risk premia. Actually, a reasonable equity premium with a too high 1-month variance premium in the instantaneous disaster risk model is just a reflection of that. Too much risk premium is attributed to short-run consumption declines. As a result, the resolution of this critique basically lies in modeling a reasonable joint behavior of consumption and equity prices during disasters. Finally, let's look at what the model implies for Welch's exercise. Here, the put protected portfolio, or K, is calculated as follows. At time t, you buy the index and the 1-month out of the money put option. Then at time t plus 1, the index value will be floored by the stock price of the put option, K, and you will earn a dividend from the index. So we compare the risk premium on each protected portfolio with the full equity premium by taking their difference and by taking their ratio. In the data, we find that 11% of the full equity premium originates from monthly declines that are larger than 25%. As anticipated by Welch, a too large portion of the equity premium comes from such big shocks under the instantaneous disaster risk model is over 40%. And in contrast, Penlice shows that slowly unfolding disaster model is more consistent with the patterns of protected portfolio risk premia. Again, this is possible because of the realistic equity dynamics during disasters. So let me briefly mention that learning is really crucial for both reasonable VIX and variance premium and for protected portfolio returns. Our model with perfect information fails in similar dimensions as instantaneous disaster risk because absent imperfect information, again, equity price reactions still give rise to too high variance premium. Lastly, you might wonder whether model-implied consumption and financial disasters are indeed consistent with the data, as we did not use that as an input. In this model, the size and the duration of disasters is not exogenous, are not exogenous model inputs, but endogenous model outputs. So remember that we targeted the duration of disasters with switching probabilities, the duration of consumption disasters, stock market jumps in normal times for the jump size and normal times jump frequency, and equity premium for frequency in the depression state. So from that, fortunately, the outcome looks good. As we see here, the model's characterization of disasters is in line with the data, similar average declines, similar distribution, and similar average durations for both consumption and stock market disasters. So actually, we wrote this paper just a few months before none of us even knew what COVID-19 is. But naturally, whenever we talk about slowly unfolding disasters, people are curious about recent events, often ask about it whenever we present it these days. So of course, the simple endowment economy misses many elements, but here's a qualitative attempt to look at the last 3 months from this model's perspective. So what happened basically in the data is a very sharp drop in the stock market in February and March, as we see here from the daily data up until yesterday, and the large quick recovery followed. How could something like this happen in this model? So there are some possibilities. First, it could be a transitory increase in lambda from a state where it was really low. So in the beginning, instantaneous risk, so in the beginning when the crisis started, instantaneous risk was really high, but then it started to mean revert and led to the stock market recovery. We can actually see something like this similar something similar in the model path that we'd looked at before. The initial quick decline here in the stock market is due to an increase in lambda and the agent's suspicion that this might be a sign of depression. In this example, it was really a depression, but equity prices do not depend on whether it is really a depression or not. That's unobservable. They only depend on lambda and the belief. So the initial reaction would have been the same if it is just a few bad shocks, transitory shocks to lambda. A second possibility is that there was a switch to the depression regime, like again in the model path that we looked at, but then we switched back to normal pretty quickly, perhaps upon all the policy intervention that was at first not guaranteed when the stock market dipped, but then ended up happening. And third, it could also be a slowly unfolding disaster. So both the disaster in this model example and the Great Depression started with a large initial decline, followed by a significant recovery. In the model, the recovery is driven by negative shocks to lambda around month 20. It becomes a little flat, as you see here. So these shocks hide the convergence of lambda towards a higher value. So maybe we are given temporarily too much hope, for example, by news about the vaccine or the low risk of a second wave. And that makes investors believe that we are not in the depression state. So pi remains low and the stock market remains high. Now, the general theme of this model is that it's impossible to know that right now. So time will tell, and we can only find out that ex post. Okay, so to conclude, we propose a model featuring slowly unfolding disasters, not only in the macroeconomy, but also in financial markets. We show that this model is able to account for various aspects of the data that have proven to be challenging for traditional disaster risk models. Of course, like all models, the rare disaster mechanism is often challenged by new empirical moments. And for disaster risk, the points of criticism are mostly about asset pricing implications. They are, however, the result of how investors perceive disasters will happen. So we show that beliefs about disasters is a powerful tool that can both make disasters look more realistic, ensuring that prices result from expectations of something that's actually realistic, and they can address asset pricing implications in normal times, like related to variance and where the equity premium comes from. Otherwise, too much risk premia, so maybe one can think that disaster risk is all about the instantaneous risk, but if we don't really do this, too much risk premia are attributed to short-run risk, and persistent variation in disaster beliefs seems much more consistent with both disaster realizations, that we don't give up on the idea of disasters, but also fixing the asset pricing implications. So all in all, we highlight the importance of modeling realistic financial market dynamics during disasters, which seems to have a huge impact on asset prices, even during non-disaster periods. So that's all I wanted to say. Thank you very much.